calm day today in the absence of any news. But since we didn't have any news, I kind of want to take a more macro view of the market right now, tell you what I'm thinking about the past, where we've been, and in the future, where we're going. I'm definitely a little less excited to buy today than I was in April, in end of March. And I'm definitely not as excited to be buying tomorrow. But if I had cash on the table, I'd be putting it to work right now. Valuations are still overall solid. They're fair. I feel like we're at a fair value right now. Before coronavirus, what led me to predict a coronavirus downturn was two things. One, the coronavirus was leading to issues in China that was hurting supply chains and all that. But two, valuations were already inflated and this incoming catalyst was on the horizon. So that combination led to that. Now it feels like we're at fair valuations. In January and February, we were at very high and inflated valuations. So keep that perspective in mind. Before we were at high valuations, now we're kind of at fair. And for the last month or so, we've kind of just been flat. That said, this week has been the best week in 6 weeks or some amount of weeks that I just heard. So we're starting to see some upward trending, but that makes me a little less attracted to buy. But that said, I do think that there will be a buying opportunity in some stocks in a couple of weeks. But before we get that, let's take a look at the next couple of weeks before we hit that opportunity. States are starting to reopen. People are starting to go outside, and hopefully will start taking their masks off pretty soon. You know, obviously safety first, but I don't want to wear a mask when I leave my house anymore. So I want things to go back to normal. And I'm very confident things are going to begin going back to normal. In China, Starbucks China is seeing a return to 80% year-on-year sales. So obviously it's not 100%. It's not where they were. But that is a dramatic increase from where they were in the midst of the pandemic. And they're a couple weeks, maybe a couple months ahead of us in this whole thing. So to put that into context, the recovery into context, Starbucks, which is a very discretionary good, you know, not everyone needs to spend $5 on a cup of coffee. 80% recovery in sales. So I'm very optimistic that that statistic will trend into other areas of the economy and paint the picture of what we might see for a recovery. People are going to Starbucks. What else are they going to be doing? Obviously, there are changes. I think work from home is a big change that's going to continue and it's going to stay. I think the gig economy and freelancers are going to be an area that definitely grows. I think that's going to be where a lot of unemployed people have to go. I think there's going to be a infrastructure package, maybe not next week, next month, maybe next year kind of situation. It's a little more long-term, a little more planning is involved with that. So I'm overall optimistic on the recovery, but I do think valuations are fair. And they're fair at a strong reopening and strong recovery assumption. So if you don't share that assumption, you should be a little hesitant to buy at these prices. Now, obviously, it's all about picking your spots. There are definitely some stocks individually that I still think are underpriced and I'm still nibbling on. You know, I have some cash and I'm using it, but I'm using my cash pretty quick. So that said, I do think that there will be another buying opportunity in the post-June 30th timeframe. This will be the time frame of earnings, and some companies that we believe are being hit or may not be hit as hard may end up reporting that they were hit even harder than expected, leading to some sell-offs after earnings. Earnings typically involve or give us some volatility, both in the positive and negative directions. So I'm not saying that you should wait until then to make your purchases. What I'm saying is if you wait, that might be a good thing to wait for. Maybe there will be some negative drop in a position you want to have in the long term, and you'll be able to add to a current position, which is what I would plan on doing, or start a new position that you think has been oversold too much, didn't think was too terrible. That's what I did with Twitter. On the last earnings call, I thought that was the best earnings call I've ever heard from Twitter, and the stock was up 10% pre-market, ended the day down 9%. So I added to my position in Twitter on that day. that's kind of how you got to look at these earnings calls. So obviously they're not now, but prices are fair. There's no problem. As Warren Buffett says, you'd rather buy a good company at a fair price than a bad company at a good price. So it's not a bad idea to buy a good company at a fair price, but you may get a good price on a good company. Those were around in March and April, not so much around anymore. It is what it is. I think the recovery is going to be strong. We're looking at some of the data from China. They're kind of leading us in this economic recovery. They have stronger job issues than we do, but they're going to probably move on an infrastructure package, which hopefully we'll take from and do as well. They've got less unemployment, which we have, so people are still getting money in their pockets. And apparently that's lasting until July. So that's a solid runway of unemployment. Hopefully this June, July transition period will be enough for a lot of those people to get back into jobs. Obviously the GOP doesn't want to extend the unemployment benefits because then people won't want to take jobs. They'd rather sit at home, take the summer off, hurt GDP, and then lose touch with the job market and really hurt them and the rest of us in the long term, which we don't want to have happen. So with that in mind, with not too much happening today, very calm, let's also note this statistic. The equal-weighted S&P 500 has been outperforming the cap-weighted S&P 500, which is adjusted for the actual valuations of companies rather than them all being weighted the same. That tells us that Microsoft, Apple, Facebook, Google, etc., they've seen the rally, except Facebook, kind of. And the rest of the guys are starting to pick up. So that's kind of a trend I'm seeing. These bigger cap companies, very, very expensive right now. Not super attractive buys. The rest of the companies, more cyclical companies that people are a little more skeptical about, they're starting to hit their stride now and may provide value opportunities. So take a look at that. And until next time, peace.